Hello and welcome to the winter 2022 Wellspire Investment Commentary. This is Michael Moriarty, Chief Investment Officer at Wellspire Advisors. I'm joined by Chris Maxey, my colleague on the investment side. Chris, we're coming once again on the heels of a fairly solid year in the equity markets, fixed income markets not so strong. As we begin 2022, there are some tangible headwinds that we're observing in the financial markets. Do you want to give us some thoughts on what those headwinds are that we're thinking about?
Yeah, absolutely. Thank you. Thanks, Michael. And nice to visit with everyone again. Last year was a really good one, obviously, for risk assets and for equity markets. We're getting the question as to whether we think that's going to repeat again here in 2022. And I think the short answer is that it's a bit unclear. Right, we have three converging headwinds that we would really cite as risk factors that we're watching for the market. The first one being inflation. That's something that everyone is talking about, and we've been talking about for quite some time now. The secondary and related one is what the Federal Reserve is going to do. So, are they going to be raising interest rates, and at what pace will they be doing that? Are they going to be shrinking their balance sheet, and at what pace are they going to be doing that? And then the last risk factor, as we see it, is that this is a midterm election year. And what typically happens during midterm election years is that the market is more volatile, in part because there's an element of uncertainty in the lead up to the election, right? The market is trying to underwrite what is the political framework going to be as we move forward, and how do I need to think about that, right? So markets do not like uncertainty. That's something that we've known for a really long time, and so those are the three things that we'll really be watching. As it relates to inflation, we continue to be very attuned to what's going on there. As we see it from our purview, much of what's happening right now as it relates to inflation is a function of supply chains, right? And supply chains effectively not working in the way that they had previously. And so, Michael, I don't know if you have any additional thoughts on the inflationary side, but I know it's something we talk about almost every single day now.
Yeah, I think that's right. I mean, the now old debate whether inflation is transitory or not. I think the definition of what is transitory is a little ill-defined. Is transitory measured in months? Is it measured in quarters? Is it measured in years? I think regardless of the time frame, I think we still maintain that the dynamic is the companies are very dynamic and have very strong incentives to resolve any supply chain issues, any supply chain conflicts. And I think that dynamic nature continues to suggest that companies are going to figure it out. They're incentivized to figure it out, and that therefore, to the extent inflation is being caused by the supply chain bottlenecks, that we anticipate them being resolved in shorter rather than longer time frame.
Yeah, I think that's a really good point. We've seen a couple of stories as it relates to companies like Amazon, where they, in the lead up to the holiday season, were using very creative measures to try and alleviate the bottlenecks that we saw at many of the ports, like in California, for example. Right, Amazon is not going to just sit idly by and let money go to waste. It's just not something that they want to do. And so they were doing some very creative things to make sure that goods were delivered and in everyone's hand in advance of the holidays. So I do think, and I tend to agree with you, that that's one of those things we believe is going to get worked out. It's just a question over what time frame, right? And I think that's going to be one of the key issues we see this year, and the Fed will certainly be tackling. The other thing that I guess we've heard a lot of questions from people on is just with respect to the performance of the S&P 500 vis-a-vis every other asset class essentially in the world. The thing that comes up is why do we as investors want to own those other asset classes and incorporate them into a portfolio, right? Just given how strong performance has been for the S&P 500 now going on many, many years.
I think the answer to that question involves keeping a sense of humility about the financial markets, about your ability to predict the financial markets. I think that we understand that almost every other equity asset class has underperformed the S&P and for most recent time frames, though we would perhaps point to the same thing for the NASDAQ going into the dot-com boom and the subsequent bust. We were looking at numbers, what the NASDAQ did during that time. The NASDAQ was down a full 80% from the peak in 2000 to the bottom in 2002. And the old adage, I could tell you, the asset that falls 90% is the asset that fell 80% and then a subsequent 50%. That was a very painful time frame for investors. We absolutely are not suggesting that the S&P 500 is going to follow a similar pattern. One should continue to have a sense of humility that we in fact cannot predict the future. And when you look at, there's very real reasons to suggest a balanced portfolio still is the right answer. We can point to valuations, i.e. valuations in almost every other equity asset class are more favorable currently than the S&P 500, whether you look at U.S. small or mid cap or international stocks. And again, something we cited in our year-end letter. There are a lot of smart people that predict both medium and long-term asset class performance, and those generally referred to as capital markets assumptions. Virtually everyone is predicting, again, small and mid U.S. companies, international companies outperforming U.S. large cap over really any horizon. So all these smart people might be wrong, but we would encourage people to continue to have a strong sense of humility.
Yeah, I think those are great points. The couple of big factors we look at: valuations, capital market assumptions, and those are telling us that this isn't the point in time or point in history where you want to load up on the asset class that has done the best over the recent intervening period.
Thank you, Chris, and thank you all for listening to the Winter 2022 WellSpire Investment Commentary.